Hey there, it's Tom Ryan, founder and CEO of ICR. Before we get into the next episode, I wanted to ask that you subscribe to the show. It'll help us get even more unique and interesting guests on the podcast and in turn continue to educate management teams and the growing ecosystem that creates value for fast-growing private and public companies. And while you're at it, head over to Apple Podcasts and leave us a 5-star rating. Very much appreciated.
What we see sometimes is like Dine brands, they're not doing a good job of bringing in Gen Z and millennials and chains that are resonating. They'll outperform most of their peers and still be able to drive positive traffic this year.
When inflation is high, every consumer dollar counts, especially in the restaurant industry where competition is fierce.
The best way you could deal with it is just driving traffic, man. Top line, that's how you leverage the P&L. That's how you widen your margins, right? So yeah, man, I think we're going to continue to see that gap widen between the winners and the losers.
Being a public company can be hard. Small missteps can have outsized consequences. I'm Tom Ryan, founder and CEO of ICR, and over the last 25 years, we've helped thousands of companies understand and navigate the stock market and the media. We'll demystify these and other increasingly complex stakeholder groups so you can focus on what you do best, building your company and unlocking your true potential. This is Welcome to the Arena from ICR. It's early in the 2025 reporting season, but new trends in the restaurant and food service space are already emerging. 2024 was a difficult year, and the industry is still adjusting, navigating the same pressures of inflation, labor cost, and economic shifts, plus some new challenges. Consumer habits continue to evolve, and technology is playing a bigger role than ever. The brands that keep up will be the ones that thrive, while others will struggle to keep pace. So as we enter the new year, what is setting the winners apart? What trends have staying power? And what can last year's challenges tell us about the road ahead? Most importantly, what should restaurant leaders watch for to stay ahead of the curve? Today's guest has been tracking it all, and he's here to break down the biggest takeaways and predictions for 2025. Michael Halen is the senior restaurant and food service analyst for Bloomberg Intelligence. At Bloomberg, Michael publishes company-specific and industry-focused research on everything from how new government policies will impact business to shifting demographics that affect consumer behavior. He communicates regularly with management teams and investors, appears as a frequent guest on TV and radio, and hosts a restaurant industry podcast called Choppin It Up. Before Bloomberg, Michael spent over a decade trading equities, later became a senior equity analyst at Sidoti & Company. He has a Bachelor of Science in Finance from Georgetown University, where he was captain of the football team, which is pretty cool. Let's enter the arena with Michael Halen.
I'd love to know, kind of in your own words, your background, what pulled you into the restaurant industry and food service, and then how did the Bloomberg opportunity come your way?
Luck basically got me into the restaurant space. I love to eat. I love food. I come from a family that loves to eat. My mom's a phenomenal Italian cook. So it was really luck. I traded out of college. I traded stocks for 11 years total, ran prop trading desks, kind of an entrepreneurial role, wore a lot of hats, and was largely automated out of a job, about 15 years ago or so. So yeah, my younger brother was working for me. He left, he saw the writing on the wall maybe a little before I did. He got a job at Sidoti doing some research. And I felt that was like kind of a hole in my skill set. And it was one of the things I really loved to do on the trading side. So yeah, Sidoti was kind enough to offer me a job. I took it. I wanted to cover restaurants out of the gate. We had a restaurant analyst. And, as you know, there's not that many publicly traded restaurants out there. So I pivoted to health and wellness.
Yep.
And then when our restaurant analyst left, I went into my boss's office, Marie Conway, and I was like, Marie, I'd love to pick up a few of Mike's names. And she's like, we'd like you to pick up all the restaurants. And I was like, yes.
There you go.
Beautiful. Yeah. And so I worked at Sidoti for about 3.5 years covering small cap restaurants, but Bloomberg came along and it was an interesting opportunity. They had industry level research for 5-6 years or so at the time, and they wanted to expand into equity research. And I don't know, I was really attracted to the opportunity to help grow this business. And now I've been here for 10 years, man. Time flies.
Yeah. It's crazy. Well, it's a great platform, and the stuff that you publish is so in-depth and interesting. So we've kind of started reporting season. Let's talk about the restaurant industry in particular. Some of the brands have come out with earnings, McDonald's and Chipotle and Denny's and Dutch Bros and stuff. And that's fourth quarter and full year 2024. Is there anything in there that has stood out to you so far?
I'd say the biggest thing that stood out to me so far is just January results.
Yeah.
And it's interesting because some chains are talking about a tough consumer environment, but we didn't see that in the data in January from Black Box Intelligence, right? And so my gut right now tells me that it's more of what we saw last year and we're going to continue to see this year is like a divergence between the winners and the losers. People have continued to be more discerning with their dining dollars, and they're going to go to the places that they know they can get a great experience and good value for their money.
Yeah. When you look at things on the last couple of years, what have been kind of the winning categories or subsegments, and what have been the ones that have most of the challenges?
Yeah. So, last year and really for a couple of years, it's been the full service dining names that have struggled the most. Casual dining had a really difficult year last year. Fine dining has really struggled now for 2 years. They got hit harder with the labor issues of a few years back. And, it's just more expensive to eat out at a full dining experience versus QSR. So they've been hit a little bit harder, but we're seeing some shifts. What we've been writing about is that QSR, who, I'm old enough to remember back in 2020 when investors were saying that quick service and fast food were completely recession proof.
Yeah.
To the point where now, because they have such large exposure to low-income consumers, they're probably the least sexy subsegment for 2025, even though Yum Brands and McDonald's have performed pretty good post 4Q earnings releases. But I think they probably have a tougher row to hoe than the casual dining names for sure, because casual dining's lapping such weak comps, right?
Yeah.
And the fast casual names we cover have just continued to outperform. And a lot of that, Chipotle, Shake Shack, think of those names. They have less exposure to low-income consumers, right? And so quick service, it's a great business. Franchise model is a beautiful thing. We love franchise models. They spit off a lot of cash, easy to predict their earnings and cash flow. But the exposure to low-income consumers is a thing because they're just more intensely affected by all the inflation that we've seen over the last 4 years or so.
100%. Sticking with the consumer for a minute, are you seeing any regional differences when it comes to like companies' same-store sales or just general performance, or is it just kind of uniform across the board, similar kinds of behavior?
Yeah, similar kinds of behavior. I would say that there were some interesting things like Florida has been hurt over the last year or so because during the pandemic, it was the only place to go.
Yeah.
Right. I remember my $200 flight tickets to Miami went to like $700 in 21 and 22. Right.
Yeah.
It really boosted restaurants in the hospitality industry in Florida. And so now that the rest of the world has opened up, that's kind of hurt Florida results, which Florida's a huge state when it comes to restaurant sales. So Florida's been lagging a bit. California last year had a couple of months of hiccups after they raised the minimum wage to $20. We think that's largely just because of bad press.
Yeah.
Because it largely recovered a few months later into the second half of the year. So those were the two main ones I would say that stood out.
Yep. And so obviously we have a new administration in there. Things are happening fast and furious, I would say. I had a few things to talk to you about. Tariffs, Make America Healthy Again, inflation, minimum wage, tax rates. You pick one or two. What do you think? What are you paying most attention to like in the next 12 months of all of those?
Oh, man, there's everything. I'm paying attention to everything. Tom, is my job, man.
Yeah. Let's talk about like inflation. If we get persistent inflation, that is just going to rock the P&Ls of like everybody, like no matter what company you're in, right?
Yeah. So, in terms of my year ahead outlook that we wrote back in November, December, that was our bigger concern this year was inflation.
Yeah.
We've been more bullish on sales this year, but margins were our bigger concern because I'm sitting there and I'm watching my Bloomberg all day, like, I'm paid to do. And ever since the market started pricing in that 50 basis point cut by the Fed, commodities have just been kind of trucking higher since September, right? And so Bloomberg Commodity Index, I don't know what it's up right now. Last I looked, it was up probably 16, 17% versus August. Oil is starting to poke its head up. That's the one of the commodities that have been lagging. And we know that if oil starts going up, the price of everything goes up because you got to ship it, right? So that's one we're watching closely. And the base effects were really easy with inflation, right? And so we weren't lapping the 8-9% inflation prints anymore, right? Now we're lapping more reasonable inflation prints. So for all those reasons, we've been kind of more worried about inflation. I don't think we're going to get anywhere near those mid to high single digit prints anymore, but 3.5 to 4 is definitely reasonable in the second half of this year. When the Fed's saying, we see 2%, it's coming. I don't see it. I don't see it in the numbers. So how do you deal with it? The best way you could deal with it is just driving traffic, man. Top line. That's how you leverage the P&L. That's how you widen your margins, right? There's work being done on the tech side to help eliminate labor hours. There's initiatives being used, but top line is the best way to solve that issue.
Yeah. So thoughts on this one. There are different incentives in public companies, depending on the cycle they're in. And some restaurant companies will take price and think about the short term, and others think very long term, and they've had a lot of success. When you've got kind of the agricultural basket plus like labor and everything's like going up, what do the smartest companies do as they think about how are we going to take price over the next few years, even if it compresses our margins? What are the best of the best doing, when they're able to navigate that kind of stuff?
Yeah, in our business, it's strategic pricing, right? Pricing your menu at each unit differently based on the economics of that market and those customers. The companies that do that well are outperforming. Chipotle has done a very good job of that. And that's why they've been able to raise their prices more than most of the other restaurant chains we cover without having a massive impact to traffic. In fact, their traffic's been better than most.
Yeah.
So strategic pricing and doing that well has really been the biggest opportunity, the best way to pass along price hikes in 2025. A place like Chipotle might be able to pass along another 4% in New York, but may not be able to raise prices at all in Alabama or Arkansas or somewhere in middle America, right? And like I said, some chains aren't even really implementing it at all. Some are just starting to implement it. Brinker's one who's finally making that push, and they're going to roll it out over, a 3-year period, right? And so that's what we like to see. We like to see companies with pricing down to the unit level and doing it well.
Yeah, which takes a lot of data and a lot of intelligence and a lot of number crunching, I have to imagine. So the big, high cash flowing, profitable companies can probably do that better than almost anybody, right?
Yeah, and then listen, there's third parties, I'll give some shout outs, man. Signal Flare AI and RMS do a great job of this. And they've had massive clients do very well with their pricing strategies over the years. So it can be done.
Yep.
It can be done. There's also consultants out there that'll help you with this. So yeah, the biggest and the best, they do it internally, but smaller chains can get some help on that end too.
How about driving traffic? I mean, it sounds so simple, but you have to turn on the marketing spigot. Potentially, loyalty programs are getting more and more sophisticated. Talk about just driving traffic in this environment and when it's like so competitive for every dollar from the consumer. Who's doing that the best? What are they doing? What makes them different?
You look at Brinker, man, Chili's drove 20% traffic last quarter.
Amazing.
Incredible, man.
My kids are going a half an hour to go there.
Oh, are they?
It's amazing, yeah.
It is. Very cool, man. And I'll talk about kind of what they've done because it relates to what we're seeing other chains now shift to. So what they did when Kevin Hochman came in as CEO, he, number one, moved to improve the operation. So he paired the menu, changed the menu to focus on its core equities, the things that really make Chili's what it is and drive most of the sales, right? And train the employees, improve the back of the house operations, and get restaurants running well again. And then from there is when you start to turn on the marketing spigot, right? That's when you start to turn on the social media marketing, TV advertising for the chains that are big enough, whatever it might be, to start bringing people in. You don't want to bring them in too early because they're going to have a bad experience and then they won't come back. So that's been huge. And I would say another one is really about value on the plate. right? And so an interesting little tidbit out of all the companies I cover, the two with the highest COGS, cost of goods sales, both have great traffic. They're Wingstop and Texas Roadhouse. They're two chains that have absolutely crushed it over the last 5 years.
Yeah.
They're offering so much more value on the plate and customers recognize it. So that more discerning customer is saying, listen, man, I get way more food at Texas Roadhouse than whatever other steak place. Or, Wingstop is giving me more wings or meatier wings versus some of their competitors. Wingstop raised their prices about mid-teens, I think, since the start of the pandemic, when food away from home's at like 25%, and then their competitors are closer to 30. People are recognizing that, right? And it's really helping.
In any market, pricing for profitability is hard for restaurants to get right. You need to balance costs with consumer value, and the margins are often razor thin. In a year where inflation continues to squeeze restaurant P&Ls and nearly half the country will see minimum wage increases, using technology to offset labor costs feels like an obvious solution. According to Michael, it's still early days, but AI and automation are poised to play a bigger role in food prep and service down the road.
Yeah, we keep seeing this 4% a year, roughly, wage rate inflation. It's going to be another year of 4% wage rate inflation for most of the companies we cover. So yeah, that's a real cost, and all our companies are working hard to reduce labor hours. I think food forecasting, sales forecasting models, and labor models, right, continue to evolve and improve. And now with the use of AI, they'll continue to make the restaurants a little bit more efficient with their labor, right? You're seeing automation, but it's not going to be implemented anytime soon. But we're seeing companies start to test it. Chipotle has that second make line underneath the counter that's going to be used just for to-go orders and pick-up and delivery orders, right? And so that's pretty interesting. Jack in the Box is working on these AI-fueled automated fryers, right, that can figure out before an employee can when to start cooking the fries, right? And
Yeah.
so you're starting to hear a lot more of these companies start to test these initiatives.
The one that I read about in your research was the Chick-fil-A lemon squeezing machine, AI powered. I need one of those.
I'm glad you brought that one up, because vertical integration, I think we're going to see more of. Salad and Go has been able to keep their margins really low using like a central kitchen, and then food manufacturing plant. And then now Chick-fil-A doing it with their lemons, right? Because cutting lemons can be dangerous. People can cut their fingers, right?
Yep.
And it's just something that can easily be done in the manufacturing facility with very little labor, and then shipped to the restaurants around the country. So I think vertical integration is something we're going to definitely see more of. The bad news I have is I don't think inflation is going away anytime soon. I mean, if you read Jim Rogers' Hot Commodities, a great book, but he talks about how commodity cycles are 17 years long. The last one was just about 10. And, hopefully that's because, technology is helping to shorten these cycles. But even if this cycle is 10 years, I mean, we started in 2021? So
it's a lifetime. In Wall Street terms, that's a lifetime.
We're not even halfway through, if that's the case, if we're in the midst of a 10-year bull cycle for commodities. So yeah, I don't see the inflation going away anytime soon.
What's top of your mind on kind of in the food service business? As we look out to 25 and 26, what are you seeing there? Obviously, the Make America Healthy movement is something to reckon with. There's a lot of food companies out there that have brands that some would arguably say could be healthier. That's a nice way to put it. But what do you see in that area, and how are companies going to kind of pivot to a new administration where someone might be really out there publicly with companies and telling them they need to change what they have?
Yeah, I'm sure our companies are already working on reformulations based on information they have. Because look, McDonald's is international. A lot of the stuff that they sell in the United States, they can't sell in Europe or Canada, right? And so I don't think it's much of an issue for the companies we cover. I think it's more of an issue for the actual food manufacturers, right? Because none of the companies I cover are really vertically integrated. Domino's makes the dough. That's about it. So yeah, I think it's going to be more of an onus on the food manufacturers. I don't think it's a huge concern for the companies I cover. Maybe they'll have to raise prices a bit to kind of offset the higher costs that they'd encounter, but we'll see.
Yeah. Back to restaurants. Cracker Barrel is a name where the brand's been around for 50 years or something like that. And they just started like a loyalty program last year. Was that too late? Yes. Are they doing it? Yes. It's had a really good start. What are the companies that you see out there that really do a great job with their loyalty program?
Well, I would contend that maybe it's not too late. Restaurants have done it so poorly.
Yeah.
The first time around, you've seen a lot, almost all of my companies kind of revamp that.
Like, what do you think they got wrong the first time around or could have done better?
A lot of it was just giving discounts to people, and a lot of them were going to come anyway. So
Yeah.
we saw that with Tim Hortons, which was crazy. They launched their loyalty program, and they have such crazy loyalty in Canada that same-store sales dropped. And it was all because of the discounts that these loyal customers were using a lot more frequently. When it comes to loyalty, it has to be more than just giving discounts to people. It has to jibe with their brand. They have to give their customers something, like maybe it's like faster access to a new product.
Yeah.
Whatever it might be. Chipotle is one that definitely comes to mind. I don't even eat much Chipotle, but my son does. I order for my son. I'm constantly getting pinged about, I got these points. I can get free guacamole or queso or whatever it might be, and use your points before they expire. And I think they do a really nice job at Chipotle of loyalty, but a lot of chains still have work to do.
Yeah. So a couple of companies have gone public recently in the restaurant space. We had like a dry spell for a while, but there are companies that are just absolutely lighting it up, like Cava. What do you think they're doing that's so great?
What I've seen, so I'm just following it. I don't cover it closely.
Yeah.
Hopefully we'll be covering it later this year, but they've also done a phenomenal job of bringing younger guests into the fold. I've noticed the lines get longer and the lines get younger at Cava. I think they also got a bump from the IPO press. I mean, we've seen it with Shake Shack, and we've seen it with pretty much everybody who's IPO'd here over the last, whatever it is, 3+ years. Chains tend to get a bump post IPO. And if you provide a great experience like Cava does, that can continue to grow on itself.
Really interesting how they're playing among different kinds of demographics. And Chipotle, I suppose, is like that. But hats off to them. They've done an amazing job. What are some of the up-and-comers that you've met? Not that you cover necessarily, but kind of interesting concepts that you've run into that you thought were cool.
Oh, man. I recently had CEO Steve Kislow from Firebirds on my podcast, Choppin It Up. Quick plug.
Yeah, no, of course.
They're doing some really cool things to draw families into the fold. And, everything's made on that wood-fired grill. So as soon as you pull up to the restaurant, the smell hits you. And I know how impactful that is, man. Open kitchens. I was in a Fogo. I went to an event at the Fogo, the show in Orlando, and they had that open kitchen. And as soon as you walk into the dining room, you smell that steak, and you start salivating, man.
That's really one of the coolest concepts, the whole like labor model at Fogo. It's like amazing. The people who serve you the food, cook it. It's like that. Actually, I don't think that happens in any other concept, but very cool. And then another one down at the conference that I thought got a good buzz was Tom's Watch Bar.
Yeah, I got to hit my first Tom's Watch Bar in Orlando as well. We had Brooks on the pod. That place is like just an incredible sports book with really good food. That prime rib sandwich, man, was awesome.
Yeah. When you look out at 25, what are the biggest things you're looking for? Because you're like so down into the weeds on all the data, everything like that. What are you seeing? What are you kind of predicting where things are going to go over the next 10 months or so?
Yeah, so I guess I'll get a little more into this top line because, I just kind of glazed over it earlier. So we've seen some improvement in the economic numbers in the back half of really the fourth quarter of 2024. A lot of the data that we look at to gauge low-income consumers had been pretty rough for the first half of the year into the third quarter. But in the fourth quarter, credit card balances continued to rise, but at a slower pace. So that's a positive. Credit card delinquencies actually fell, which was very good to see. Auto loan delinquencies were up very slightly, but it was a big time rate of change improvement. So all those are better, right? And then on top of that, we're more bullish on upper middle, and then high income consumers because asset prices now are at all-time highs, whether it's the S&P, crypto, gold, home prices, all of them are at all-time highs. And so there's, I think, pretty good pent-up demand from those higher income cohorts for restaurant dining this year because, the data showed that everybody was kind of cutting back last year.
Yeah.
And so, being more bullish on that consumer segment. And then, of course, we're lapping a restaurant recession, in our opinion, and really weak results. And so for all of those reasons, as well as a pickup in sales post-election in November and December and January, according to Black Box Intelligence, all of those reasons make us more bullish finally for 2025. And so that's a big one, and we expect this divergence to continue, right? Chains that are resonating, chains that are doing a good job of drawing in these younger generations seem to outperform. So, Chili's, Wingstop, they'll outperform most of their peers and still be able to drive positive traffic this year. So yeah, man, I think we're going to continue to see that gap widen between the winners and the losers.
It's kind of like pretty simple. If you can drive the revenue, you're going to do great, right? I mean, that's it. If you can get people to come in, and that's not easy, you're going to be a winner and you're going to be taking market share. Even though the overall pie might be growing, it's still a battle. Do you think you'll see some capacity come out of the market this year?
What we see sometimes is like Dine Brands. Last year, they took some capacity out. They closed more IHOPs than they expected.
Yeah.
Again, for probably like the fourth consecutive year, they closed more Applebee's than expected. But that's a brand that's not resonating, right? They're not doing a good job of bringing in Gen Z and millennials. And so they're continuing to struggle. The chains we cover, they're all growing. The food service industry, we cover US Foods and Cisco. They're expecting some solid case growth this year. So, I don't necessarily think there'll be a lot of capacity coming out. I think you'll continue to see chains turn over.
Yep. But kind of net, it'll be about the same probably, right?
Yeah, I think so.
After a year of cautious spending and economic uncertainty, 2025 looks promising for savvy food service brands ready to break away from the pack. The winners in the space are making smart moves, prioritizing value, fine-tuning pricing, and leveraging technology to do more with less. With post-election spending already on the rise and higher-income consumers driving demand, growing top-line revenue enough to offset inflation is a real possibility, but not for everyone. As Michael pointed out, the gap between winners and losers is widening, and the choices being made today will shape the industry's next chapter. Welcome to the Arena from ICR. We're working really hard to bring you exciting guests and great content. If you found this episode insightful, please subscribe to the show on your podcast app and leave us a 5-star rating. The more the show grows, the more interesting voices we can have on the podcast, and in turn, that should demystify a lot of the stakeholders around public companies and soon-to-be public companies. Thank you so much for listening. A big thanks to Michael Halen for joining me today. His research is helping investors and industry leaders keep their thumbs on the pulse of the food service industry, and it's always interesting to hear the stories behind the numbers. 2025 is going to be a wild ride, so buckle up, and we'll be watching the restaurant space closely to see how it responds. We'll see you next time back in the arena.
References to specific stocks are not intended to be recommendations for specific trading behavior. Comments presented on this podcast are intended for informational and educational purposes only, and do not represent opinions or recommendations on whether to buy, sell, or hold shares of a particular stock. All investors are advised to conduct their own independent research into individual stocks before making a trading decision. In addition, investors are advised that past stock performance is no guarantee of future price performance.